Hello and welcome to your daily note for February the 17th, 2022. So we got more economic data, retail sales specifically, and industrial production. You're going to have housing starts, building permits, initial jobless claims, and existing home sales for the rest of the week. But we also got the FOMC minutes that came out, and that's going to give us a little bit more clarity around balance sheet reduction. So we have a lot to dig into in today's daily note, as well as how the market interpreted all that information. So let's start with retail sales. Prior month was at 16.95. Current actual was 12.96, so a reduction here. Digging into some of the key information from it: advanced estimates of U.S. retail and food services sales for January, adjusted for seasonal variations and holidays and trading day differences, but not for price changes, were $649 billion, an increase of 3.8% from the previous month and 13% above January 2021. What's interesting is retail sales trades were up 4.4% from December and up 11.4% from last year. Gasoline stations were up 33.4%, while food services and drinking places were up 27%. Digging into the underlying charts underneath, you're going to see where the biggest change from 2021 came from building materials, gardening, and supply dealers, up 12.7%. Again, gasoline stations up 32.7%. Clothing and clothing stores were up 19%. Small reductions in sporting goods, hobbies, musical instruments, and bookstores down 0.8%. Miscellaneous stores up 13.2%. And then food services and drinking places up 24.9%. Coming down a little bit further, just to see the month-over-month changes: retail food services up 3.8%. Motor vehicle and parts dealers up 5.7%. Furniture and home furnishing 7.2%, building materials 4.1%, health and personal care stores down, gasoline stations down, sporting goods, hobbies, and musical down, and a big increase in non-store retailers. If I go back, non-store retailers are elective shopping, and so I think that one's interesting because it's a very broad category for such a large increase. But one of the things that I think, that we're seeing in this retail sales data is primarily you're still seeing a reduction in retail sales from April. That has been slowing now since the spring of last year. But at the same token, I think it's also being held up a little bit by credit cards and other revolving loans. We have seen loans pick up. We've seen those pick up since March. Which I think is keeping somewhat of an elevated level on these retail sales data, because we've seen personal income come down, we've seen the savings rate come down, right? So with credit cards and revolving credits up 7.6% year over year, I think that's also keeping the retail sales data somewhat elevated, but again, still a reduction overall in retail sales from the April level. You're still seeing a pretty good slowdown here. Now, you're going to see the same thing in industrial production. So going back here, industrial production came in prior month at 3.67, an acceleration up to 4.08% for the current month. Again, it looks like a very, very similar chart when you flip over to industrial production. You had a peak in the springtime of last year and a big decline coming right back down and kind of returning to this mean here. So some key highlights from industrial production. And so in January, total industrial production increased 1.4%. Manufacturing output and mining rose 0.2% and 1% respectively. And this is a real big one. The index for utilities jumped 9.9% after being held down in December by unusually mild weather. And the demand for heating surged in January with the arrival of colder weather, which is down here at the bottom. At 103.5% of its 2017 average, total industrial production in January was 4.1% higher than its year earlier level and 2.1% above its pre-pandemic level. Capacity utilization for industrial sectors increased 1 percentage point to January to 77.6%, a rate that is 0.9% below its long run average, so capacity is still somewhat lower. You are seeing just a broad case of an increase throughout January in production, so 1.7 in final products, 2.2% in consumer goods, 1.5% in materials, 9.9 in utilities, and 1% in mining. One loan reduction in construction, down 1.3% there. Coming down a little bit further, I do want to hit on that utilities because it was such a large spike. The increase of 9.9% in output of utility in January was the largest in history of the index and reflected strength for both electric utilities and natural gas utilities. The index for mining rose 1%, oil and gas well drilling advanced 6.2%, and the index in January was nearly 50% above its year earlier level, but still about 14% below its pre-pandemic readings. So it's still the same flavor as we turn the calendar on the new year, and we kind of flip over here and we look at what's been doing so well. Oil up 15.6% for the year and natural gas up 18.12%. You're seeing that again being confirmed and reflected in the industrial production. One thing I do want to note here in the charts of industrial production is there's not a lot of growth that has been happening in production basically since 2010. So if you look at just general levels as they've been ratio scaled to 100 here, capacity has not really gone anywhere since 2010, and production hasn't really gone anywhere since 2010. They've been very much in kind of this moderating path compared to what we've seen in kind of like the 80s, where capacity and industrial production were growing very rapidly. So I think that's very, very critical and very key. That does probably point to a sign where we continue to moderate back down to this normal level trend. And so I want you to be cognizant of that, because this is part of this normalization, is that we're slowing down from a growth perspective at the same time that policy from both the fiscal and monetary side are being removed. And that does flip us over to the Fed minutes. Again, I told you this was going to be a little bit of a longer one because we had so much information coming out. But we have been trying to understand how the balance sheet is going to be reduced. I think we have an understanding, and we've talked about this in other daily notes. We have a pretty good understanding of the interest rate path. They're going to raise rates either 0.25% at a time, or, if they're behind the curve, they may jump 50 basis points. But for the most part, they're going to start to come up to that 2-year rate that I showed you in previous communications. But today we want to hit on the minutes here. So I've gone through it already, and I want to read you some of the highlighted notes here. So first, in additional matters, I think this is really important. The committee authorizes the chair of the committee in fostering the committee's objectives during any period between meetings of the committee to instruct the selected bank to act on behalf of the committee to A, adjust somewhat in exceptional circumstances the stance of monetary policy, and to take actions that may result in material changes in the composition and size of the assets in the SOMA, or undertake transactions with respect to eligible securities in order to appropriately address temporary disruptions of an appropriation or highly unusual nature in U.S. dollar funding markets. So again, reaffirming that Jerome Powell has the green light. If he sees something that needs to be moved interim in between meetings, doesn't have to necessarily have a committee meeting, he can go ahead and get it done. I think that's something that might have been overlooked, but I think it's important nonetheless. Come down here a little bit further, and let's make sure that we cover the statement on longer run goals and monetary policy. So the Federal Open Market Committee is firmly committed to fulfilling its statutory mandate for the Congress of promoting maximum employment, stable prices, and moderate long-term interest rates. The committee seeks to explain its monetary policy decisions to the public as clearly as possible. Such clarity facilitates well-informed decision-making by households and businesses, reduces economic and financial uncertainty, increases the effectiveness of monetary policy, and enhances transparency and accountability, which are essential in a democratic society. Now, the committee judged that the level of the federal funds rate, consistent with maximum employment and price stability over the longer run, has declined relative to its historical average. Therefore, the federal rate is likely to be constrained by its effective lower bound more frequently than it has been in the past. Owing in part to the proximity of interest rates to the effective lower bound, the committee judges the downward risk to employment and inflation have increased. and the committee is prepared to use the full range of tools to achieve its maximum employment and price stability mandate. The committee did reaffirm the 2% target. The one that I always like to point to is this slide here. Appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. Some time has very little clarity to it, and this is the moment where we're going to get more clarity to that, given that inflation is running above 2% for some time, and they start to fight it. This gives us some benchmark to go off of for further policy in the future. Coming down a little bit lower, talking about financial market developments, we saw Treasury yields rise across the curve, led by higher real yields, expectations for tighter monetary policy ahead, as well as an easing of COVID-related concerns were cited as contributors to increases in yield. The S&P 500 index declined around 5%, with sharp moves towards the end of the period, reportedly promoted by concerns about the implications of a tighter path of monetary policy and rising geopolitical risks. Now, regarding the monetary policy outlook, with data showing continuing tightening of the labor market conditions and elevated inflation pressures, policymakers' communications were perceived as pointing to an earlier and faster removal of accommodation than market participants previously expected. And against this backdrop, respondents to the open market desk survey of primary dealers and market participants almost uniformly projected that the Federal Reserve's net asset purchases would end by mid-March. So again, sooner than I think most market participants expected, which again was really interesting to see the rally at the end of the day yesterday, given the fact that this is them telling you that, hey, we're going to tighten a little bit faster here. Still going here, the median survey projection for the commencement of balance sheet runoff shifted into the third quarter of this year, so again pulled forward almost roughly a year and a half sooner than in the December surveys just a month ago. So most survey respondents also expected the portfolio to decline to a significantly faster pace than they did in December, and expectations for the path of the federal funds rate shifted towards earlier rate increases, and interest rate futures priced in an increase in the target rate for the federal funds rate at the March meeting. On average, respondents to the desk survey assigned a roughly 7% probability to an increase in the target rate in March. That's probably closer to 100% at this point, but at the time of this it was 70. The expected path of the federal funds rate in the desk surveys and derived from interest rate futures also steepened over the period. The median survey projected for most likely level of the target rate at the end of 2024 was about 2%, similar to December. Nonetheless, survey respondents attached significant probability to outcomes to which the target rate moved up more than indicated by the projected model path. So again, this little section that we just read is a key indication that they are moving into the tightening phase, moving into it faster than market participants expected, and moving in an earlier fashion. Going forward here, they did note that there was wider spreads in mortgage-backed securities, and this, again, probably is in response to the fact that the agency mortgage-backed securities are going to be rolled off faster. We've seen that, and we've highlighted that in our rescaled range notes. Going up here for just a second. So here's mortgage-backed securities. You can see, if I can scroll down here, you can see the risk that has been building up recently that feels very similar to a COVID period. But judging by the minutes, you're going to see several central banks concluded their net asset purchases late last year, and more were expected to do so this year. Nope, I'm sorry, I'm jumping ahead here. Many of these respondents, and I thought I highlighted it, and I guess I didn't, they have talked about removing mortgage-backed securities and only purchasing, here it is, and only purchasing treasuries. So jumping into the principles for reducing the balance sheet, this is where I think we're going to get the most information that we need to help guide us as far as the tapering process. So at this meeting, participants discussed high-level principles that could be released to the public to describe the committee's approach for reducing the size of the balance sheet. They agreed that the principles would address at a high level the sequence of adjustment in interest rates and balance sheet tools to reduce policy accommodation, the committee's approach to balance sheet runoff, and its intentions for the longer run size and composition of the balance sheet. The participants' discussion was preceded by a staff presentation that reviewed key considerations raised by participants at the December FOMC meeting and examined how the proposed set of principles which reflected these considerations compared with the policy normalization principles in 2014 when they last reduced the balance sheet under Janet Yellen. So, in kind of keeping with the committee's long-run objectives, they found that it would be appropriate to begin the process of reducing the size of the balance sheet after the process of increasing the target range for the federal funds rate has already begun, meaning that they're not going to do a double-barrel approach right out of the gate. They're going to raise interest rates first before they start reducing the balance sheet. While participants agreed that details on the timing and pace of the balance sheet runoff would be determined at upcoming meetings, participants generally noted that current economic and financial conditions would likely warrant a faster pace of balance sheet runoff than during the period of balance sheet reductions from 2017 to 2019. So to give you some context and clarity, in 2017 to 2019, they shrank the balance sheet by about $400 billion. What they're telling you is they're going to have to do more than that. They're going to have to move faster than what they did in 2017 and 2019. And $400 million compared to what they have done is a drop in the bucket. I think we all know that. Participants observed also that in light of the current high level of the Federal Reserve security holdings, a significant reduction in the size of the balance sheet would likely be appropriate. Participants noted that the level of security holdings consistent with implementing monetary policy efficiently and effectively in ample reserve regime was uncertain, and probability would also continue to remain so. Consequently, market conditions would play a key role and would have to be monitored closely to determine the appropriate longer-run level of reserves and the size of the balance sheet. Participants agreed that committees should reduce the Federal Reserve's holdings over time in a predictable manner, primarily by adjusting the reinvestment amount. So not necessarily selling off what they already have, but maybe stopping the reinvestment and letting those just naturally roll off. They also agreed that the SOMA account should hold primarily Treasury securities in the longer run. And regarding these two principles, many participants commented that the sale of mortgage-backed securities or reinvesting some portion of principal payments received from mortgage-backed securities into Treasury securities may be more appropriate at this point in time and also in the future to enable suitable progress towards a longer-run SOMA portfolio composition. So again, reiterating the fact that they're going to remove mortgage-backed securities from their purchase list here. So one of the other final notes is down here all the way at the bottom. They did agree to continue to purchase securities all the way through the month of February. It looks like mid-March might be where they turn this off. But look at this voting against. Nobody voted against. Everybody voted for. So it was for a unanimous decision on these minutes here. And I think, again, what you're seeing is this flavor of, okay, we're going to begin the tightening policy. We're going to do it faster. We're looking at stopping our purchases in mid-March, lifting rates off in March, and we're going to have to move faster than our tightening policy in 2017 through 2019, which was roughly $400 billion is all they were able to roll off at that time. So I think this, again, is all in part why we're seeing this general sell-off since November, which is where I think you got most of the peak, even after your small upward rally in December here. But this decline continues, again, primarily in both the equity market and in the fixed income market. Fixed income market getting hurt because of higher interest rates as your 10-year is back above 2 at 2.03 and your 2 years above 1 at 1.5. And then the equity market pricing in the fact that the balance sheet runoff is going to reduce liquidity in financial markets and tighten financial conditions. You're starting to see that spill over into credit spreads as well. So the high yield option adjusted spread is widening and tightening. That looks like it's going to continue. One of the other interesting things about this chart, if I could show you, is if you were to invert the high yield option adjusted spreads, you're going to get a pretty clear path of market expectations. And I'm going to show you this here. So stress in the high yield market or the junk bond market can correspond very well to sell-offs in the equity market. If we just invert the high yield options adjusted spreads, give my computer time to catch up here. Maybe. There we go. So now that it's caught up, anytime spreads begin to widen in the high yield market, you see a consistent sell-off in the equity market. So here again, widening, a sell-off in the equity market, spreads widening, and you get kind of this flat move in the equity market. We're in a situation again where spreads are widening and you're getting a sell-off in the equity market. So I think all this points to is that volatility is rising on the back of uncertainty around tightening policy, uncertainty of financial conditions, as we just looked at industrial production slowing, retail sales slowing, pointing to growth slowing. And so we continue to reaffirm our stance that, remaining defensive, we're moving through the first part of this year is and will continue to be appropriate. No real moves in the rescaled ranges that jumped out at me as I looked through them this morning. Again, the market rebounded towards the end of the day on the news that retail sales came in at another hot clip and the FOMC meetings came out. But again, it seemed a little bit counterintuitive because we're still seeing a slowdown in both industrial production and retail sales, and we got a pretty bad news on tightening policy there. So stay diligent. We're going to see how the housing starts and the building permits come out. Those are technically leading indicators, so if those are picking up, that could bode well for the back half of the year. But again, I think you're getting a pretty clear flavor of what information came out yesterday morning. So if you all have questions around the balance sheet runoff, around any of this economic data coming out, or how the market's interpreting it, please feel free to reach out to us, shoot us a comment, or send us an email. We hope you have a great Thursday, and we'll be back again tomorrow with an update on the housing starts and building permits.